Sei Network, a Layer 1 blockchain built specifically for trading. Unlike general-purpose blockchains, Sei has positioned itself as the backbone for decentralized exchanges, order books, and liquidity providers, with technology designed for speed and low latency. But with competitors like Solana making a comeback and platforms like Hyperliquid already generating massive revenues, the big question is, can Sei carve out its niche and deliver real long-term value? Let's break it down from fundamentals, tokenomics, ecosystem growth, and the big catalysts that could shape Sei's future. Price actions and price prediction for 2025 bull run. Looking at Sei's Elliott Wave structure on the 4-hour chart, the price action seems to be following a classic corrective pattern after the strong impulsive move earlier this year. We can clearly identify Wave I as the initial impulse leg, followed by a corrective wave ABC structure. Currently, Sei appears to be in the latter stages of Wave B, which has retraced into key Fibonacci zones between the 38.2% and 61.8% levels. The highlighted support box between 19 cents and 28 cents is crucial, as this is where buyers are likely to step in if the correction deepens further. From here, a breakout above the descending green trend line would be an early confirmation that Wave C is underway. The measured move for Wave 3 of C projects upside targets in the 65 cents to $1.25 range, aligning with the 100% to 161% Fibonacci extension levels. In simpler terms, while short-term downside or sideways action is still possible, the broader Elliott Wave count suggests that Sei could be setting up for a strong bullish impulse once the corrective phase is complete. Tokenomics and inflationary economics of SEI tokens. SEI is a capped token with a 10 billion total supply and a current circulating 6.0 B at the time. The protocol deliberately left a large portion of tokens controlled by ecosystem and foundation allocations to fund multi-year incentives. So price action for holders is a function of both real activity, TVL, DEX volume, transactions, and scheduled supply releases. That means the big chunk of tokens are already in circulation, and the extra supply coming in the future is small compared to the full 10 billion. The good news is that these unlock schedules are public, so investors can anticipate most of the dilution. The main risks come if the ecosystem fund, the pool of tokens set aside to grow the network, spends too aggressively, or if the team decides to change the release plan in unexpected ways. Sei has a market cap of $2 billion and about 6 B SEI tokens circulating, and the price is $0.33 per token. In a bull run, if adoption, TVL, and usage of Sei chain increase meaningfully, there is a lot of room for price appreciation because many tokens are already out there, but most value comes from what people do with the chain, apps, fees, staking, etc. Fundamental analysis. Sei Network positions itself as a specialized Layer 1 blockchain optimized for trading applications. With its parallelized execution, ultra-low latency, and native order matching engine, Sei targets the intersection of DeFi, trading infrastructure, and high-frequency applications. The thesis is that Sei could become the default blockchain for decentralized trading if adoption scales, but risks include competition from other high-performance L1s and uncertain regulatory landscapes. SEI's adoption can be evaluated through on-chain activity such as total value locked, TVL, active wallet addresses, transaction throughput, and decentralized exchange, DEX, volumes. At present, Sei's TVL remains modest compared to larger competitors like Solana and Ethereum, although it has shown signs of growth following its mainnet launch in late 2023. Early performance indicators highlight the network's technical strengths, positioning it as a high-performance blockchain optimized for trading applications. In terms of sustainability, its long-term viability is tied to the structure of its tokenomics, particularly staking rewards and inflation mechanics. The SEI token launched with an initial annual inflation rate of approximately 7%, which is programmed to decline over time. This inflation provides incentives for validators and stackers to secure the network, but also creates potential supply overhang. The balance between maintaining attractive staking yields and ensuring the token has sufficient utility in real economic activity will be critical in determining Sei's long-term sustainability. Major apps and ecosystem activity on Sei. One of the leading DeFi apps on Sei is Yay Finance, which works like a lending and borrowing platform, similar to what Aave does. It has grabbed a large share of Sei's TVL, especially with stablecoins like USDC and USDT, meaning people are using it to earn interest or borrow money. Its growth helped push Sei's total locked value higher. Another important protocol is silo stake, liquid staking, where SEI holders can stake their tokens, locking them up to help secure the network, but still have more flexible ways to use value. Liquid staking gives you some derivative tokens or staking yields while keeping liquidity. That draws people who want yield plus utility. DragonSwap is the native DEX built on Sei. People swap tokens there. Its launch was a key moment because having a reliable, fast DEX increases the utility of the chain. More trading equals more fees plus more engagement. On the wallet of infrastructure side, Compass Wallet is a big deal. Mobile plus browser wallet that allows people to access, say, dApps, stake, manage NFTs, etc. A good wallet makes it much easier for new users to start using the chain. There are also cross-chain or bridging efforts. Sei has integrations with BitGet Wallet, bringing more users per tokens into Sei via campaigns, and partnerships with bridges or cross-chain tools to let assets and users flow in from other chains. Sei is also supporting NFT marketplaces, like Pallet Exchange, and developer tools and infrastructure, e.g. analytics, explorers, RPC or indexer tools, that make the chain easier to build on and more transparent, which helps attract both builders and users. What this means for price upside if a bull run hits. If usage of these apps keeps rising, two things happen. First, more fees get burned if Sei burns a portion of fees, which helps combat inflation. Second, staking is more attractive, so more tokens get locked up, reducing circulating supply. When demand goes up, more users, more trading, more dApps, and supply, liquid available tokens, is either stable or shrinking. Price can increase a lot. Right now, the chain shows good momentum. Increasing TVL, growing number of users, more wallets integrating. If that continues in a bull market, people looking for high-growth L1S, speculative capital flowing in, Sei has many of the pieces in place. Good DEXs, staking/liquid staking, wallet integrations, NFT plus cross-chain bridges, dev tools. That gives potential for tremendous upside, especially since many tokens are held by long-term/institutional or staking positions. Sector and macro view. The broader Layer 1 blockchain sector remains intensely competitive, with Solana regaining momentum, Ethereum scaling solutions attracting significant capital, and a range of alternative L1s vying for market share. In this environment, investors are increasingly focused not just on technical performance, like transaction speed or throughput, but on real-world adoption and liquidity that can stick on-chain over the long term. From a macro perspective, institutional adoption of digital assets is gradually returning as global interest rates begin to stabilize, creating a more supportive risk-on backdrop. At the same time, regulatory uncertainty, particularly around how the SEC classifies tokens, continues to act as a near-term headwind, limiting upside until clearer frameworks emerge. A notable positive trend is the recovery of decentralized trading volumes after the steep decline in 2022, signaling that users are once again shifting activity on-chain. Hyperliquid has emerged as one of the strongest competitors in the trading-focused blockchain niche, and it's already showing the kind of adoption and revenue traction that Sei aspires to. The rivalry comes down to how each positions itself in the broader DeFi market. Hyperliquid is built as a dedicated decentralized exchange with its own app chain. It has optimized for perpetual futures trading, high throughput, and smooth user experience, which has helped it gain traction quickly and generate real revenues. Traders like Hyperliquid because it feels closer to a centralized exchange in speed and usability, but still operates natively on-chain. This has created strong network effects around liquidity, making it a sticky platform for active derivatives traders. Sei, on the other hand, is trying to position itself as a general-purpose Layer 1 optimized for trading applications. Instead of being a single exchange, Sei wants to be the infrastructure layer where many trading-focused dApps, spot DEXs, perpetual platforms, options protocols, liquidity providers, can be built. Its parallel execution and sub-second finality are meant to attract not just one app, but an ecosystem of trading apps. The risk, though, is that if users prefer an integrated product like Hyperliquid, Sei may struggle to differentiate unless it attracts a killer app with meaningful volume. In simple terms, Hyperliquid is like the Binance of on-chain derivatives, while Sei is trying to be the Ethereum/Solana for trading-specific apps. Both target the same audience, on-chain traders and liquidity providers, but Hyperliquid has the advantage of being a proven product with strong revenue, while Sei is still at the infrastructure stage, relying on its ecosystem to build traction. If Hyperliquid continues to grow and expand its product set, e.g., adding spot markets, structured products, lending, it could absorb a large part of the trader base Sei wants to capture. On the other hand, if Sei can incubate multiple strong dApps and create a thriving ecosystem where liquidity and traders can move across applications, it might offer broader opportunities long-term. Catalysts to watch. In the short term, the main catalysts for Sei over the next 1 to 3 months revolve around token unlock schedules, which may introduce sell pressure if large amounts of tokens hit the market. At the same time, any new exchange listings or trading incentive programs could boost visibility and activity, while ecosystem fund deployments and fresh dApp launches would help draw in users and developers. These short-term factors are critical for driving momentum, but they can also create volatility depending on whether the net effect is more supply pressure or stronger adoption. Looking further ahead, over the 6 to 12-month horizon, the key drivers of Sei's growth will come from deeper integration with large-scale decentralized exchanges and perpetuals platforms, which align with its core identity as a trading-focused Layer 1. Strategic partnerships with trading infrastructure providers, such as liquidity providers or quant firms, could also strengthen Sei's positioning as a hub for on-chain trading. Most importantly, sustained growth in active wallets and total value locked, TVL, would demonstrate real adoption, providing the kind of sticky liquidity that investors are looking for. Overall, Sei is a specialized L1 optimized for trading, with strong technical differentiators that set it apart. However, adoption remains in its early stages, and the current valuation appears ahead of fundamental growth. Tokenomics, particularly future unlocks, pose a near-term challenge, though broader sector tailwinds such as the migration of liquidity to decentralized platforms and continued regulatory scrutiny on centralized exchanges are supportive of Sei's long-term positioning. Ultimately, Sei's success will depend on building a deeper ecosystem and securing lasting liquidity inflows. Investment summary. Sei positions itself as a specialized Layer 1 blockchain designed for trading applications, with strong technical features like parallel execution and sub-second finality that set it apart from many competitors. However, adoption is still in its early stages, and the network's valuation appears to be running ahead of its current fundamentals, creating a gap that needs to be closed through deeper ecosystem growth. Tokenomics also remain a short-term concern, as significant future unlocks could put sell pressure on the market and weigh on performance. On the positive side, sector-level tailwinds, such as the migration of liquidity to decentralized platforms and ongoing regulatory pressure on centralized exchanges, support Sei's long-term narrative as a trading-first chain. Ultimately, its success will depend on whether it can build out a robust ecosystem with sticky liquidity and sustained user adoption. Concluding remarks. So, to wrap this up, Sei is an ambitious project with real technical strengths and a clear focus on trading applications. The challenge lies in turning that vision into adoption, building an ecosystem strong enough to attract sticky liquidity, and navigating token unlocks in the months ahead. While the short term might see volatility, the long-term story depends on whether Sei can become the go-to chain for trading apps. If you found this breakdown helpful, make sure to hit that subscribe button and turn on notifications so you don't miss my next deep dive on crypto projects.